Let me tell you the story of Max, a clever but troubled man who found himself tangled in a web of illegal activities. Max wasn't always a criminal. He used to work at a car dealership, but after losing his job during tough economic times, he became desperate. He started selling stolen electronics and counterfeit goods to make ends meet. Over time, his operation grew, and he was making thousands of dollars every month. But there was a problem. All that money was dirty. Max knew that if he just deposited large amounts of cash into his bank account, the bank would get suspicious and report him to the authorities. So he needed a plan to make his illegal money look legal, a process called money laundering.
So money laundering is the process of making illegally obtained money, such as from criminal activities, appear legal. It typically involves 3 stages: placement, layering, and integration, where the money is introduced into the financial system, moved through complex transactions to obscure its origin, and then reintroduced as clean money. So far we've covered the first stage of the 3 stages, which is the placement. Now my fellow students, let's continue with our lessons until the last lap.
Let's continue with our Money Laundering 101 lesson. Let's hear Max's plan. Step 1. Placement. Getting the money into the system. Max's first challenge was to get the cash into the financial system without raising red flags. He couldn't just walk into a bank with a duffel bag full of cash. That would be too obvious. So, Max came up with a clever idea. He created a shell company called Sunrise Consulting Services. On paper, it looked like a legitimate business that provided consulting services to small businesses. Max registered the company in a country with weak financial regulations, making it harder for authorities to investigate.
Next, Max started depositing small amounts of cash into the company's bank account over time. Instead of depositing $50,000 at once, he would deposit $2,000 here, $3,000 there, amounts small enough to avoid triggering automatic reports to the government. This technique is called smoothing or structuring. Max also used his shell company to create fake invoices. He would write invoices claiming that Sunrise Consulting Services had provided consulting work to various businesses, even though no real work was done. This made it look like the money coming into the account was from legitimate business transactions. So now we're gonna define these 2 techniques, namely smoothing or structuring. Let's start by breaking down the concept structuring. Structuring is the deliberate act of splitting large amounts of money into smaller transactions to avoid triggering financial reporting requirements. Think of it like this: if you have a big pile of money that would attract attention, you break it into tiny piles that look innocent. How it works. The threshold: in many countries, like the US, Canada, and Australia, banks must report any transaction over $10,000. This is called a currency transaction report, CTR. The strategy: instead of depositing $50,000 at once, someone might deposit $9,000 today, $9,500 tomorrow, and $8,000 the next day, all staying just under the $10,000 limit. Multiple accounts. Criminals may use several bank accounts, different branches, or even ATMs to spread out the transactions and avoid detection. Key characteristics. 1. Illegal regardless of source. Even if the money was earned legally, structuring is still a crime because the intent is to evade reporting requirements. 2. Simple execution. Structuring can be done by a single person without a complex network. 3. Tax evasion, sometimes used by individuals, like corrupt officials, to hide income and avoid paying taxes on bribes or kickbacks. Example. A business owner who earns $30,000 in cash wants to avoid reporting it. Instead of depositing it all at once, they deposit $7,000 on Monday, $8,000 on Wednesday, and $9,000 on Friday across different bank branches. Like, subscribe and share for the next part. So now we're gonna define these 2 techniques, namely smoothing or structuring. Now let's break down the concept smoothing. Smoothing is a more sophisticated form of structuring that specifically involves illegally obtained funds and uses a network of low-level criminals called smurfs. The term smurf refers to junior money launderers or runners who carry out the transactions on behalf of the main criminal. How it works. The network, a criminal organization, recruits multiple smurfs to carry out small transactions on their behalf. Each smurf deposits small amounts of cash into different accounts, making it harder to trace the money back to the original source. 3 stages. Smoothing follows the classic 3 stages of money laundering. 1. Placement. The illegal cash is introduced into the financial system through small deposits. 2. Layering. The money is moved through multiple accounts, sometimes across borders, to obscure its origin. 3. Integration. The clean money is reintroduced into the economy, often used to buy property or goods. Key characteristics. 1. Illegally obtained funds. The money being laundered is almost always from criminal activities like drug trafficking, fraud, or theft. 2. Use of intermediaries. Smurfs are recruited to carry out the transactions, creating a layer of separation between the main criminal and the financial system. 3. Geographic movement. Money is often moved across borders using digital transactions or physical cash smuggling. 4. More complex. Smoothing involves coordination among multiple people and accounts, making it harder to detect than simple structuring. Example. A drug cartel has $500,000 in cash from illegal sales. They recruit 10 Smurfs and give each one $50,000. Each Smurf then deposits $9,000 into different bank accounts over several days. The money is then transferred to offshore accounts, layered through investments, and eventually used to buy real estate. Special type, cuckoo smoothing. In cuckoo smoothing, criminals hijack legitimate money transfers. Here's how it works. 1. A legitimate customer asks a remittance service to send money abroad. 2. A corrupt service provider replaces the customer's money with illegally obtained funds. 3. The customer receives their money, unaware of the swap, while the criminal's dirty money appears to come from a legitimate source. Why they matter. Both techniques undermine the integrity of the financial system and enable serious crimes like drug trafficking, terrorism financing, and corruption. 3. The United Nations estimates that $800 billion to $2 trillion is laundered globally each year. That's 2 to 5% of global GDP. 8. Understanding these techniques helps financial institutions, law enforcement, and compliance professionals detect and prevent money laundering before it causes further harm. We've completed the first part of the series, which is the placement. Now we're going to focus on the next step of the lesson, which is layering, making the money hard to trace.